a new club at Mcmaster Investing Club, so it just started this semester, and there's no other club in the MSU like it. So we're pretty excited that you could all join us. So I'm just going to go on and introduce the exec. So I'm Charmine, and I'm Director of Communications.
Hi, I'm Michael, I'm the President.
Hi, I'm Lane, I'm the Vice President.
I'm Vicky, Director of Promotions.
And I'm Perry, I'm the Director of Marketing.
Okay, so before we begin, we just have a quick disclaimer that anything you learn here today, if you decide to go out and invest on your own, we're not responsible for any money you lose. But if you make any money, feel free to give us a cut. I'm just kidding. Okay. And now I'll pass it on to the rest of the exec for our actual seminar.
Okay, so we're just going to talk about different ways that you can do online trading. So you have like the big five banks that people usually go with, or you have an online option. The major difference between the two is this is usually more convenient, as most of you already have accounts with these banks. But they do charge a high transaction fees. On the other hand, the online ones are quite cheap. And they're usually not as safe as one with a normal bank. Okay, so just to give you an example of investing, so our president Michael here invests quite a bit, and this is a real life example from him. So he started off, he bought shares from MFC, Manulife Financial, for $12.60, sold them at $16.72. This was the net gain and a dividend of $19.50, which insurance companies usually pay, giving you a total rate of return of 30% on it in 1 month and 7 days. This tells you how lucrative investment banking really is. This is a quick summary of what the TSX was like from 1980 all the way to 2011. You can see that the graph goes up. This clearly shows that investing is a very good option. Even if you have like a little dips in the middle or something, in the long run, you will make a lot of money investing.
Alright, so I will now talk about a few biases that exist in the world of investing. The first bias is the myopic loss aversion, and basically what that is not locking into your losses or maintaining your stocks even after they're not attractive anymore. So let me give you an example. Let's say you buy 100 shares of Rogers at $30 per share, and then after a while the price goes down to $25 per share. So that's 5 times 100, so you just lost $100. I mean 500. And and that's human nature, because people will still want to maintain the stocks because they don't want to lose. They try to prevent losing than actual winning. Studies have shown that losing is twice more powerful than winning. So sometimes it's just good to give in and just before you lose it all. Yeah. The second type of bias is anchoring, and that's basically making decisions on irrelevant information. So let me give you an example. When let's say an investor decides to buy a stock, the stock that's half the price it was the previous year, and because they're thinking they're getting a good deal, but really the only way that that's a good deal is if the stock itself in the previous year was actually fair and reasonable, and the stock's fundamentals haven't changed. The third type of bias is recency bias, and that's just making decisions based on the recent past. So if the previous years a stock has done really well, then you're going to assume that the next year is going to be doing just as well. Another bias would be the expectation bias, and that's just basing your decision on what you expect. So if you expect that a stock is going to do well, then you're just going to more likely invest and just fall into that kind of mentality. So this graph will be shown to explain the next two biases, which is herd mentality, and that's just buying what everybody else is buying, and buying high and selling low. So for example, as you can see, the company is doing really well, and everybody just started following everyone else, and then the stocks went really down, and basically everyone lost. So it's pretty self-explanatory. So how do you overcome these biases? I mean, they're all human nature, so anybody can really make them. The first thing you want to do is stick to numbers and avoid background noise. You want to prevent subjective assessments from influencing your decision and just focus on like real hardcore data such as balance sheets and whatever else the companies might provide you with. The second thing you want to do is you want to understand the full history so you can avoid the recency effect. And you also want to follow proven strategies such as value investing and Warren Buffett. He's an American investor and one of the most successful investors in the world. He's the primary shareholder, CEO, and the chairman of Berkshire Hathaway. It's basically this company in Nebraska, and it just manages other individual companies. It's hard to explain, and he was ranked in 2010 as the third wealthiest man in the world.
Okay, so now I'm going to introduce some of the stocks that did well in 2010. The first one you guys all probably know is gold, and in last year went up 29.6%. This was due to QE2, which is known as quantitative easing 2. Basically, it's the U.S. printing money, which happened a lot last year. What this does is it increases the supply of the U.S. dollars and drives down its value. So since gold is priced in U.S. dollars, gold obviously increased last year. The second one that did really well was Tim Hortons, which you all obviously know and probably contributed to its stock success. Shares rose 34% in the last year, and Tim Hortons actually sold its stake in its only bakery for $475 million, when its initial investment was only $75 million. So you can see that they've done really well in the last couple of years, and from the chart you can see that as well. The other one is Lululemon, which most girls probably know, and I don't know if you guys really buy that. And they started the year with 32.5 and ended the year around $65. So they went up basically 100%. And you guys should have invested in stock rather than just buying the clothes. And the last one that did really well last year, which everyone knows, is Apple. And they gained over 50% in 2010 because they launched the iPhone 4 and the iPad. And in the most recent quarter, Apple sold 7 million iPads, and it's the leader in the tablet market right now. I'm going to hand it over to the next exec.
Okay, so now we're going to go through investing strategies that you can actually go out and use right away. So the first one is value investing, and that's Warren Buffett's strategy. That's basically buying stocks that are underpriced in fundamental analysis. Now we'll explain fundamental analysis more after, but what that means is you're analyzing a company's financial statements, you're looking at the competition, you're looking at the economy. Looking at those factors, you find companies that are undervalued, and that happens. The market will sometimes misprice stocks temporarily, misprice them lower or higher than where they should be. Now you find these stocks that are mispriced on the low side, you buy it, wait till it goes back up to market value, or even higher, then you sell. And that's how people like Warren Buffett make money. Second one is growth investing. Now this is riskier than the first one. So you're investing in companies with above average growth, meaning that these companies are growing their revenue and earnings at a high rate. For example, Research in Motion, the maker of the BlackBerry, buying that stock would be growth investing because that's a company where the revenue and profits are both increasing at over 20% a year. Of course, buying those companies would be riskier than value investing, but the potential for gains is also higher. Third one is income investing. Now that's also a very safe way to invest. You're basically buying stocks in companies that pay a dividend. For example, Martin's that you saw earlier pays a dividend. All the bank stocks, including Royal Bank, pay a dividend. So now we're looking at two ways to analyze. So as we talked about earlier, fundamental analysis. That's simply analyzing a stock using financial statements, looking at the competition, and looking at things such as the economy. Second one is technical analysis. And in a way that's opposite to fundamental analysis because you're forecasting the direction of a stock using past data, most importantly price and volume. So this is when people look at the chart of a stock and predict where it's going, up or down. You don't really care about the competitors. You don't really care about the economy. All you're looking at is basically the chart and forecasting whether or not the stock will go up and down. And there are people who like doing that. Now, 2 routes to financial freedom. This is based on an article that was in the Globe and Mail recently. This is about 2 individuals who are individual investors, so they're not professional, but over decades they've learned a lot about investing, and now they have 2 ways of investing that are working very well for them. And we'll take a look at the first one. So the first method is called indexing, and the individual's name is Graham Tweedy, and his portfolio is 6 figures, and now he's 60 years old. So early on in his life, Graham Tweedy made a mistake. He got burned by a penny stock that was recommended to him by an associate. Then he got burned by a mutual fund, which had a star manager. So with a star manager, the mutual fund did really well one year, and then next year it bombed. And that's human nature, because even though it's a star manager running the mutual fund, he's human, and so he will make mistakes, and he can sometimes underperform. And thirdly, he was burned by the rising Canadian dollar on his US investments. So when you buy US stocks, that's in US dollars. If the Canadian dollar goes up, your US stocks are losing value because the Canadian dollar has gone up relative to the US dollar. Now, because of those 3 mistakes, Graham Tweedy has come up with his strategy, which is indexing. And this is something that you all can do right away. This good thing about this is very easy to do, because with indexing, you're essentially buying the entire index. So as you can see, his portfolio, 40% is equity, 40% is meaning stocks. And there's only 2 stocks in his portfolio. And these are ETF index funds, so it's a fund that has an entire index. So with this method, you don't need to look at each company individually. You're buying the entire index. So 2 stocks, HIC, which is the Canadian, essentially Toronto Stock Exchange. And the second one is the XSP, which is the US Stock Exchange. So you're buying these 2, and it's 40%, so half and half. And the other portion of his portfolio would be, and the good part about this method is that the fees are very low. MERs, which are management expense ratios, 0.25% and another 0.25%. This is lower than mutual funds. Typically on mutual funds you'll pay somewhere from 1 to 2% a year, and that does add up over many, many years. So this is a very cheap way to invest. So we mentioned the 40% stocks, so 60% is simply fixed income, so it's simply GICs with different maturities. And there, he follows the age equals fixed income rule, so that applies to us too. So he's 60 years old, that's why it's 60% fixed income. In the audience, if you're 20 years old, then you would have 20% fixed income, and 80% would be in stocks, meaning that